I've asked my students to read or to reread a little about the different forms of business, different forms businesses can take, and then to send me some questions about things they weren't quite sure about. So this video is going to answer some of those questions. The first question was about being a sole trader, and it asks if it's dangerous if the business goes bankrupt and why. The slide here I think helps to explain what the problems are. So a sole trader, it's owned and run by one individual, but they may employ other people. It's very simple to set up. You just start running a business. It's not incorporated. It's not gone through the legal process. However, the risk it has is that because it's not incorporated, it is the same entity as the person who runs it, as the sole trader. This means that together with the fact that sole traders have what's called unlimited liability, anything that the company becomes indebted for or owes could be taken out from the individual sole trader's bank account, or worse still, taken away from, for instance, their house could be removed, their car, their tools, other possessions. So there is no distinction between what the sole trader has paid in to start the business and what could be taken out from the business. Whatever the sole trader has in their bank account or owns could be taken as a result of actions that they take while a sole trader. This could mean that, for example, if a window cleaner causes thousands of pounds of damage because of smashing windows in a historic building, they could have the money taken from their own personal accounts, or, as I say, even their house or possessions taken to pay for that. There is no limit. Once they become a limited company, the liability becomes limited, and therefore there is a distinction between the money that's being paid into the bank, the money that's being paid into the business, and the person who has paid that money in, and it limits the amount that can be taken away from the person who has paid in, a shareholder. It limits the amount that can be taken away from them to only the amount that they have ever paid in from the first place. No more can be taken away from them. So moving on to the second question, this leads on directly. Are shareholders like sole traders but shared by multiple people? So you can see that if I just pause this and change the slide a moment. So now I've put this slide onto the role of shareholders, and we can see that shareholders have quite a different purpose. Whereas the sole trader runs the business because they are interested in running the business for themselves, a shareholder, firstly, as we just said, can put money in to buy a share of the business. If it's a private limited company, LTD, then that means that the person could pay money in, and those shares can only be sold with the agreement of other shareholders. But a public limited company, the shareholders can't say who else could be a shareholder because the shares are sold on the stock exchange. Notice that the role of the shareholder, key elements, they may say how the business is run, they can vote on certain issues, but of course they don't sit in the management meetings day in, day out, so they can't directly say day to day what will happen within the company. A shareholder risks giving some money, but the benefit of that is they should be paid a dividend. That's a little bit of the profit every 6 months or whenever it's offered. So it's the equivalent to putting money into the bank and getting interest, except it may happen, it may not. And what could happen is if the business goes bankrupt, they could lose their money, all the money they invested, but because it's limited, no more than that. They cannot have other possessions taken away from them. So one of the things is that their liability is limited. They put buy a share in the hope of having a dividend. They may want some say in the business, but may not have a direct influence on it. And they may sell shares for a profit later more likely if it's a public limited company and those shares are available on the stock exchange. So that's the big difference between a shareholder and a sole trader. Finally, the last question is, if shareholders take the dividends, does it mean they use the profit to pay employees, or does that money come from somewhere else? Well, you'll see in year 2, when we start to look at balance sheet and income statements. Here is the income statement, an example of an income statement. And what in fact happens is we take the cost, the amount that has come in from the business through the year from its sales. We then take the direct cost of those sales. Now that may be paying for employees to make the product. So right from the start, we begin taking things like employee salary out. That's part of the main cost. We then get what's called the gross profit. We then take off other expenses. Now those might be things that are not directly associated with the specific production of the goods, but still forms part of an expense. These may be, for instance, or management pay, things like that, or costs that can't be directly attributed to the making of the product. And perhaps any exceptional items, like a large item that's been sold or a large expense that's come in 1 year. This comes down to operating profit. We then take further amounts off, including taxation, giving us profit for the share. It's only at this point, this final point, where anything that's left over that they wish to is shared out as a dividend. It may be that they choose not to, but the income statement will show what they could be giving out as a dividend. And that's where the final profit goes out to the shareholders. I hope that helps explain it.